Today's guest is Brendan Bell, Chief Operating Officer and Partner at Aligned Climate Capital.
We own and operate wind, solar, battery projects around the country.
He's using that decades-long experience now at Aligned Climate Capital to experience a rare dual strategy.
Infrastructure is designed to be something that is very stable. At Aligned, we have different funds. We have different investors in our venture fund than we have in our infrastructure fund. We need to change how we have transportation. We need to change land use. Now, there's clearly software and technology tools that can be used to accelerate that and do that well.
If you want to hear what it's like to be inside the DOE at that moment, what infrastructure investors are looking for, this is the episode for you.
This is a global market. The more deployment we get of electric vehicles globally, of wind and solar and batteries globally, that's driving down commodity prices. And that only makes these technologies more affordable to consumers.
Welcome back to Clean Techies. Today's guest is Brendan Bell, Chief Operating Officer and Partner at Aligned Climate Capital. But one of the most interesting things about this episode is before that, he helped lead one of the most important pivotal clean energy programs in the country, and that is the Department of Energy Loans Program Office during the Obama administration. So when he was at the LPO, that was actually when we got the first utility scale solar project and early loan to Tesla. And so he's using that decades-long experience now at Aligned Climate Capital to experience a rare dual strategy. We talked a lot about the venture side, but what's honestly more nuanced is owning and operating infrastructure projects like solar, wind, and storage. We talked to him about how to be front and center in infrastructure and what the fundamentals of that investing practice is. If you want to hear what it's like to be inside the DOE at that moment, what infrastructure investors are looking for, how to balance moonshots with scale, community solar, distributed storage, mid-market projects, takes on tailwinds, headwinds, and the global race for electrons, this is the episode for you. I'm so glad we could get this for you all, and I think you'll really, really enjoy. All right, let's get into the episode.
All right, Brennan, welcome to the show. Great to have you. How are you?
I'm great. Thanks for having me on the show. Appreciate it.
Yeah, really excited. This is a nuanced model. We already sort of talked about that a little bit, but there's a lot of sort of new ground I think we're going to cover. We don't often have many guests. I won't spoil it right now, but that are working in your specific area. So yeah, why don't we kick it off? Please, who are you and what do you do?
Sure. Yeah, I'm Brendan Bell. I'm the Chief Operating Officer and one of the partners at Aligned Climate Capital. And as our name probably gives away, we invest in clean energy and climate solutions. We have both a venture strategy and we have an infrastructure fund.
So really quickly, can you just outline for us venture strategy? I think we know pretty well, sort of direct equity positions and early stage companies. What is an infrastructure strategy?
Yeah, an infrastructure fund is really just we own and operate wind, solar, battery projects around the country. In our case, we invest exclusively in North America. Obviously, there's infrastructure funds that are global in scope. But yeah, it's sort of the two ends of the spectrum, right? You sort of the earliest stage in venture, and then we own operating assets. So it is a little bit of a strange position to be in, but we think it makes sense.
What is the goal when you're owning and operating a clean energy asset, right? The goal of ventures is sort of have a big outcome and sort of back on someone who writes the right trend and executes the right way. What would you describe as the goals of an infrastructure model?
Yeah, it's a great question. So I think infrastructure is designed to be something that is very stable, that is generating cash for the investors. And just to be clear, at Aligned, we have different funds. So we have different investors in our venture fund than we have in our infrastructure fund. So they're looking for different outcomes. You're not looking for the 30x return because you back the right company. You're looking for it all to play out exactly as you had expected. Right. So there's current cash yields. We're making cash distributions to our investors every year as we sell electricity and other attributes. So it's just really a different strategy. But again, in our world, as you know, it all relates to each other. Right. So we have venture companies that are supporting infrastructure assets, and it's all really built around this clean energy transition.
So maybe one thing I'd love to do this is put this in perspective. Right. So on early stage technology, which you participate in, you're kind of looking for these moonshots, sort of the next generational trend, but you're probably looking for slightly different things on the infrastructure side. What makes a good infrastructure deal, especially from a climate perspective? Like there's sort of this double line there.
Yeah, and I would say even on venture, we're probably maybe a little different. My bad joke is that we're an infrastructure investor stuck in a venture body. So we tend to back companies that are investing or have services in that sector. We're probably doing fewer breakthrough technologies than maybe some other venture investors. But for infrastructure assets, really what you're looking for is a project that has as much of the variables eliminated as possible, right? You're looking for as little risk as possible. So you want to know who's going to buy your electricity. You're going to want to know that you have fixed prices on your lease payments. You're going to want to know that you have warranties and wraps around the technology. So you want as few things to go wrong as possible so that the actual performance looks exactly like your financial model, right? In infrastructure, that's maybe, sort of, the holy grail, right? Is everything looks exactly as you had planned it out. And that is what your investors are looking for. Obviously, in venture, we're having to take a much more forward view of what companies are going to be successful, what management teams, what sectors, what technologies. And so there are sort of different skill sets. But I think the two different perspectives on the same market are really helpful. When we look at a venture company, if they're involved in infrastructure and their assumptions around what those kind of assets will look like and how they perform, that's a red flag for us, right? We know what that's supposed to look like, and if it doesn't look quite right, it's not a great sign.
This model is pretty nuanced. I'd love to sort of break down the journey that helped you get from starting your career, taking an interest in this sort of space, and how you ended up at Aligned. So please walk us through that.
Yeah, I have a very non-traditional pathway into finance. I started my career working for the Sierra Club. So I grew up next to a nuclear power plant and got really involved in what that meant in terms of energy and our environment and our community. And so I'm 45. I graduated college in 2002. And at that point, if you wanted to work on climate or clean energy, you could basically work in the government or you could work for a nonprofit. And so I worked for the Sierra Club for a number of years running advocacy campaigns around clean vehicles, clean energy. I then went to go work for a solar developer, a very unsuccessful solar developer that went out of business and went back to grad school, came back, worked in the U.S. Senate, worked for a senator named Frank Lautenberg, who was a senator from New Jersey, ran his committee on the Environment and Public Works Committee. And that's how I met my current business partner, Peter Davidson, who's the CEO of our firm. After leaving Senator Lautenberg's office, I went to go work at the Department of Energy at the Loan Program Office, which is basically just a big bank inside of the Department of Energy. That was under the Obama administration, the second half of the Obama administration. And so Peter had just been brought in to become the executive director of that program. I got brought in as his deputy. And we were in charge. This was after the Solyndra loan had blown up and had been in a very highly publicized bankruptcy. And we were in charge of getting the program back up and running, getting the loans performing, and getting the program back in business. And that's what we did over the second half of the Obama administration.
I think the LPO has definitely become a sort of very relevant entity. And especially in the past administration. But we'd love to understand your experience with it, right? So what was your role? Some research tells us Director of Strategic Initiatives. So I'd love to understand what that means and, kind of the fun and stuff you're able to do there.
Yeah, no, it was a title that really didn't mean a whole lot. But basically what I was is so Peter and I were the two political appointees at the LPO at that time. So we were both appointed by President Obama to run the program. And when we got there, the LPO had made a number of loans, about $32 billion loans, but most of those projects hadn't actually gotten built yet. So we were first and foremost in charge of, all right, let's make sure these projects get built. And so the loan program office has about 160 people, a large team of engineers overseeing these large capital projects that we needed to get built so that we could get our loans repaid. It was also a big, we did a lot of internal improvements. We made sure that the loan procedures were improved. There were a lot of recommendations from various government agencies that had sort of said, look, this is the better way to run a loan program. And we also had to go out and meet a bunch of companies that had sort of written off the LPO at that point. It had been out of business for a couple of years. With Solyndra, we had to go back and say, hey, we can actually help you deploy your technology. We can help your business. Here's what we can offer, right? And so it was a great opportunity. This was 2012 through 2016, kind of the clean energy transition really starting to accelerate. And Peter and I got to go meet a ton of great companies, great executives across the country, many of whom we've now invested in maybe it wasn't that company that they were at, but now they've started a number of the companies. So it was a great experience. At that time at the LPO, we did the first 10 utility scale solar projects in the country. Half were solar PV, half were concentrating solar. And it's really, at least for me, looking back, it's 10 years ago. 10 years ago, we didn't know if concentrating solar or solar PV were going to be the winning technology, right? I think now we know that solar PV is clearly one, right? It's one today, it's the dominant technology. But a decade ago, we didn't know that, right? And that is part of the power of the LPO and government programs, is to support technologies, let them see if they can really gain commercial traction. And then the private sector can come in and back them. Before we had done those projects, there hadn't been a solar project in the U.S. more than 10 megawatts that had gotten a commercial loan, right? Which is crazy to think about today, right?
That's awesome. Yeah.
We're doing billions and billions of dollars loans, and that's
Yeah.
exciting, right?
Yeah. And so, starting from convincing people, right? You're kind of operating on first principles, right? There's no precedent. There is a story to tell, and that story has to, appeal, and then you kind of execute on it. So I'm curious, what was the discrepancy? And this is maybe now that you're sort of a couple years removed, you can kind of see this now in 2020. What was the story you were selling, and how did that kind of pan out?
Yeah, I think the story we were selling is that we could actually execute, right? I think the fear was that, hey, we're going to go in, this is a government program, we're going to spend 2 years just kind of chasing our tail, and then nothing's ever going to happen. So I think it was convincing people we were back open for business, we were interested in doing loans, we had the support of the president and the Secretary of Energy, who was Ernie Moniz at that time, to put capital to work. And we did do new loans, and we did them across the board. So we did renewables projects, we did electric vehicle projects. We did the first loan to Tesla, we did a large loan to Ford, Nissan. We also did the first new nuclear plant in the country. So the Vocal plant in Georgia that was built by Southern Company, we did a loan for that project that got that off the ground. So it was really just convincing people, hey, we're a counterparty that you can trust. We will do what we're saying going to do. It's basic business, right? It's if I'm going to spend my time and money to try and engage with you, I need to know that you're really going to be a good partner.
And so as you look to kind of what the role the LPO is taking on today, especially now you're operating for more of the private sector, how has your understanding of and frankly, sort of the role of the office itself, right, as it's matured and sort of taken on previous administration and a new life, now that you're on the private sector side, how would you define the relationship between yourself as an infrastructure fund, and now it's sort of we're under a different administration, but what had that role become, and sort of what has it become now, and sort of the pretty big change in the past year?
Hey founders, if you're hiring, I've got a special offer for you. For those of you who do not know, to pay the bills, I run a search firm called Earth Tech Talent. That's Earth with no A. We specialize in placing top sales and engineering talent at early stage clean tech startups in the United States. And we do it for way, way less than traditional search firms. I've actually been working as a recruiter for over 5 years in clean tech and have made over 70 placements, from the CTO of IPA Power, a Blackstone-backed energy developer, to most of the founding team at ChargeScape, a managed charging software joint venture between Honda, Ford, BMW, and Nissan. Early stage clean tech startups can't afford to not have the right talent, but they also cannot afford to use a traditional search firm for their recruiting needs. That's where we can help. We charge as low as 12% of first year base salary, and this is compared to the typical 20 to 30% that most firms charge. So you can get an expert in the space at a price that does not break the bank. If you'd like to learn more, check out our website, earthtechtalent.com. That's, again, Earth with no A. And we really value transparency, so our pricing is publicly available on the website. If you're looking for support, book a call today. My calendar link is in the description, and be sure to reference this ad for $1,000 off of your first search. All right, back to the show.
Yes, obviously, certainly the program's changed a lot, and we saw something similar after Peter and I left, and the first Trump administration, they stopped doing a lot of loans, right? But the program does survive, right? It's still got its portfolio, it's still supporting that for taxpayers, and it's still, I think that's the important part, right? We need programs like this, we need public policy, because when Peter and I were there, we were trying to see, all right, is thermal storage going to take off? Is solar PV going to take off, right? Different set of technologies that we now know work and have a commercial life and can be supported by the private sector. I think the mission of the LPO just evolves as technology evolves, right? So when Jigger and his team were there, they were looking at a different set of technologies that had the same market problems, right? They may be different technologies, but they were really trying to show a lender that does not want to take risk that we're bankable, right? At the end of the day, that is the basic, that is the hump that the LPO gets a technology over, is to say, look, we will back the first few commercial deployments of this technology. We will show that it works. We will show that we can get paid back, that things don't completely fall apart, and then the private sector can take over. And I think that's the power of it. And And what I worry about with the current slowdown of loans is there's technologies that we really need to come online in the next decade at commercial scale, direct air capture, metals recoveries, all these sorts of different technologies that need that help now, right? We can't lose another 4 years of, you know, stopping the commercialization machine, right? And that's what I worry about.
It's this is a rare opportunity to kind of speak to someone who's sort of seen both the inside and outside, and now sort of span the test of a couple administrations. So, given this role and how you look at things, sort of what do you believe is the role for infrastructure? Like you said, there's sort of progress that needs to be made. So how can you help us understand what progress can we expect when it comes to infrastructure being owned and operated and built, right? So the typical example you said was there needs to be more solar farms, more wind power, like turbines and things like that. Especially as we look to what the ecosystem is like today. What is the role that infrastructure play? Where is your energy going? Where are you spending time?
Right. So I think infrastructure investors are in many ways the end buyer, right, for a lot of clean tech venture companies, right? Whether you're developing projects and selling to an infrastructure fund,
Yeah.
whether you have a service that is, ultimately being financed by an infrastructure investor because they're paying the project costs, right? So I think our opinion is if you're in clean tech or climate or clean energy, whatever we want to call it, and you don't understand infrastructure, you need to learn that, right? Because at the end of the day, our industry, in our view, looks a lot more like traditional oil and gas than it does, say, software, right?
And what
That
do you
doesn't
mean
mean
by
that we don't have software. Well, at the end of the day, we're producing to decarbonize. We need to change the built environment, right? We need to change how we produce power. We need to change how we have transportation. We need to change land use. We need to change how buildings operate. Now, there's clearly software and technology tools that can be used to accelerate that and do that well. But there is a physical component of this that is very capital intensive, that is, just at the end of the day, something different than, say, a consumer app, right? Or a fintech company, right?
Yeah.
So we have to have understandings of those systems as well, and I think that's where we sort of, our view is that the existing sort of fossil fuel industry has lessons to be learned from our sector in terms of how to operate well, how to understand assets, how to understand markets. All those things are important.
I've had the pleasure of spending time with many of the great guests that we've had on the show in Houston, right? Very oil and gas ecosystem there. And it's so interesting, the difference in energy, the difference in perspective, right? All valuable. And rather, especially if you come from an infrastructure point of view, probably a little more mature, right? In what they're trying to do. But it's so interesting how even the geographies have sort of divided people into silos in terms of how they think about energy and decarbonization. I wasn't planning on asking this as a question, but I guess on that, sort of where do you think you learn the most, right, about sort of best practices in your world? Where it's sort of oil and gas, or where are you finding your best practices?
I think we have to be open to everything, right? I think the tech industry, I live in Los Angeles, so it's probably I'm going to get kicked under the table for saying this, but the Bay Area, like what the Bay Area has created over the past few decades, is incredibly powerful, right? There's so much to learn from that in terms of automation, in terms of using machine learning, AI, everything like that, running large multinational global companies. There's things to learn from that. There's things to learn from, the traditional energy providers, oil and gas. There's also, our headquarters is in New York. The financial industry has been financing assets and companies for a long time. There are financial tools that people need to use. One of the things that we do a lot with our portfolio companies on the venture side is say, hey, there's something called credit, right? You don't have to just fund your company with priced equity rounds, right? There's credit products, there's project finance, there's all sorts of different capital formations that you can use to grow your company, particularly if you have certain profile of company. So I think if we're really going to achieve the carbon reductions that we need to, if we're going to do it at the scale and the pace that is necessary, we got to learn from everywhere, right? And I think that's where we sort of see it. Is I think you don't want to just be one thing. You got to take lessons from a lot of different places and government, right? I think that's the other piece. Policy does matter.
Yeah, well said. And I think so. To your perspective, you probably have since you have license, like you said, to operate as a venture shop, given sort of industry background, you can be in both worlds. Kind of talking about these contrasting understandings, perspectives. What do people often get wrong about infrastructure? right? So people kind of have an idea of what they think infrastructure is and investing in infrastructure is, but what are some common misconceptions?
I think a common misconception is how quickly infrastructure investors are going to change, and how interested they are in innovation.
Yeah.
So I think just by virtue of the asset class, similar to credit, infrastructure is very risk averse. You're trying to manage and mitigate your risk. So, we'll come across venture companies that are, hey, I've got a great new tool that's going to allow, infrastructure investors to do asset management in this way, right? And look, that may be great, but the adoption rates are, I think, going to be a lot slower than they expect, because you have to not only convince the infrastructure investor themselves, but their insurance company, their lender, their tax equity partner. So there's always multiple parties involved in infrastructure assets that are generally inclined not to change, right? And you have to convince them that it is safe, stable, and better, right? And so I think those are sometimes the challenges of how do you sell a new product, how do you get innovation to occur in what's purposely a very conservative investment strategy industry, right?
And so if you can highlight for us sort of what would you say are some unique risks to stability you deal with?
Mm-hmm.
And I think it would be helpful to understand it specifically as a climate infrastructure player, right?
Yeah.
There are probably things dealing with the types of energy that we have, the types of asset classes the assets, that we try to own and operate. What are some of the unique risks that you can educate us on?
Yeah, well, let me give you an example. So, there are some new innovations in solar panels, right? Perovskite modules and things like that. And some of those companies are trying to get off the ground, or new tracking technologies, or new racking technologies, right? Doesn't matter what it is. And so a lot of times those companies will come to asset owners and say, hey, could we pilot something with you, right? Could you put, our product in 5% of your project? And the challenge, and I think they're sort of expecting, hey, yeah, great, I'd love to pilot something because this could be better. The challenge then is I have to convince my lender that this part of my project is not going to become a problem. It's not going to underperform. I have to convince them that even though I have a 10-year warranty on all the other equipment in my project, this portion of it doesn't have a warranty. What happens if it breaks? What happens if it needs to be replaced? And oh, by the way, it's a venture-backed startup that is is providing a warranty on that. So I think it's those kinds of issues, right? It's not just convincing the investor; it's convincing all the parties that they rely upon that this is worth the change, right? And I think it's why it's harder for venture stage companies to break into some of that in terms of hardware manufacturing and equipment supplying. It just requires a very large balance sheet. It requires corporate partners, and so I think that is something where, one of the things that Align, we really, when we're looking at a hardware company, we really need to understand how do you convince a Nextera, a Brookfield, a whoever, that you're bankable. It's not just that it works, right? Just because it works doesn't mean it's going to get adopted or it's better, right?
Yeah. And how would you describe the infrastructure space today? Would you say it's a crowded space from sort of the competition investor perspective, or are there gaps that could still be filled?
I think there are definitely gaps. Look, infrastructure is a broad asset class. It's global. There's different segments of it. People talk about it in sort of core plus, value add. Core being just we're owning operating assets. They're very stable. Value add being a little bit more you as the investor do some things necessary to improve the value of the asset. That's what we do in our strategies. We buy projects from developers when they're fully developed, but they haven't been built yet. They haven't been financed. And so we do all that work as our fund, and then we look to aggregate those portfolios and sell them to much larger investors.
Yeah.
But I think infrastructure as a class, particularly global investors, European investors, Asian investors, the Middle East, very interested in the asset class. It's particularly in challenging economic environments. It's sort of seen as appropriately a stable investment class to balance out some other volatility. So yeah, it's interesting, right? We at Aligned, we live at two very different places in the market, but it's still I think we have portfolio companies that we use as a service provider in our infrastructure business, and likewise we have portfolio companies that have met each other through our infrastructure business. So it's a good way, at least in our view, to see a broad view of the market.
Yeah. And if you had to pick sort of one investment or style Right. I think the reason I'll give maybe the backdrop of this question first, which is when people hear infrastructure, they think solar, right? They think wind. They think, and with that comes a lot of the, for lack of a better term, scars with those investment opportunities, right? And people might come at it with different opinions. In doing the research for this, I saw you call out a couple different examples, right? Community solar, distributed energy, right? So somewhat more niche defined terms. Can you walk us through a technology area or an asset area that you're particularly excited about? What a project type that we should be looking into or aware of
Yeah.
as exists? Yeah.
Yeah, I mean, look, we've built a lot of different types of projects, owned a lot of different types. Our current funds target community solar and distributed energy storage. I think we're really excited about, and this, you'll sort of hear this throughout our conversation.
Yeah.
We're about deployment, right? But for venture companies, we want to see somebody that can help speed deployment. We want to do more assets. We want to get more built. We want to have more consumers be able to take advantage of all these solutions. So the nice thing about distributed storage and community solar is your times to interconnect are faster than utility scale. Your ability to permit them is faster. So we're basically looking at, as everybody knows, an environment where for the first time in 80, 90 years we have really rapid electrical demand growth in the country, right?
Yeah.
And so how do we meet that demand growth, right? You can't really build new natural gas plants for 5 to 6 years unless you've already put in your orders for turbines, because you just can't get the equipment. Utility scale, it's much slower interconnection process. Obviously, we still will see that come online, but we really think this sort of mid-market, so not residential solar, not on your home, not utility scale, but this kind of, call it 1 to 10 megawatt project.
Yeah.
It's easier to site, it's faster to build, and the market needs the power.
Yeah. The idea of mid-market, right, coming from different disciplines, introduces their own sort of novel risks and complications. I'm curious if there's anything that you're learning in real time about the nuance there.
Yeah, I think these markets are very regional. They're fragmented. You got to really be an expert and know the sector. But that creates opportunity. In our view, creates opportunity, right? We want to go into these places where, it's similar in venture, right? Certain venture investors target very specific verticals or subsegments, or they're a seed investor that really targets this type of company, right? Because they feel like they know that market better than the generalists, and they're looking for generalists to come in at Series B or Series C onward, but they see the opportunity sooner. And that's, I think, just for us on infrastructure, we look to operate at a scale that allows us to come in at a time that we think is better for our investors, and then look to sell de-risked assets to the larger infrastructure investors that are looking for lower returns than we are and have larger pools.
Yeah. Then I'm curious, like, building on that, where do you see sort of the ability for the ecosystem to move forward given the current climate? Well, not ironically, given the current infrastructure setup and policy landscape that's sort of on everyone's mind. I think there are niches where people get very enthusiastic and sort of everyone kind of hones. So within your world, where has the momentum shifted, for lack of a better term?
Thank you so much for listening thus far. If you're enjoying the episode and want to keep it going, please go to cleantechies.substack.com and subscribe for a premium membership to get access to the rest of this episode and the rest of our amazing guests on future episodes. Thanks so much.